you're right to highlight that the U.S.'s withdrawal from the Paris Agreement is a setback for a global net zero journey, but it doesn't change the fact that many U.S. companies are still pursuing a low-carbon business model and are looking at ways to have more control over their energy needs in the light of volatility in the oil price, geopolitical risk, supply chain risk. So I think you will still see the U.S. market decarbonize and transform to better address climate risk, but it won't be because there's regulatory pressure to do it. It will be because it's just good business sense. It makes economic sense.
Welcome to The Greener Way. I'm your host, Michelle Baltazar, Executive Director of Media here at FS Sustainability. We are recording on Gadigal land and we pay our respects to the traditional custodians of country and elders past and present. Today's guest is TCorp's Head of Investment Stewardship, Alexis Cheang. She will share her insights on the first investment stewardship report by TCorp, which manages more than $118 billion on behalf of the New South Wales government. Alexis, thanks for joining us.
Thanks for having me.
First, congratulations on your inaugural report, which was, I believe, released in May this year. How does it feel to get the first one out to market, and what feedback have you received so far?
It feels great, Michelle. It's been a labor of love for 2 to 3 years now. And with the publication of the Investment Stewardship Report, we've actually concluded all 21 recommendations in Prue Bennett's independent review into TCorp's sustainable investment practices. We've received really great feedback from stakeholders so far. They've told us that it's easy to read, they understand it, even if they're not an expert in ESG, and that it's honest and candid about our climate ambition and the dependencies we face in achieving that. So the goals we had in producing this report were brevity, clarity, and readability, and I think we've achieved that.
I can vouch for it. I did read the report, and it felt accessible. Even for someone like me who's not an expert, I definitely don't feel overwhelmed with the technical jargon as I was reading it. So what was the process like looking at your investment portfolios? I mean, that's a lot of money to look at. And what kind of manpower was required to put the report together?
So we have lots of tools that support us to analyze our total portfolio all the time. That's kind of what we're doing on a day-to-day basis. But pulling together the most accurate data across all of our asset classes, particularly when it came to carbon emissions data, was very challenging. It took deep data analysis to identify errors, and we found many. It took a commitment to partnership and working with our vendors and data providers to clean up data and improve it where things were looking strange. But at the end of it, it also made us much more familiar with our portfolio ESG risks and more confident in the information we ultimately published in the report. But beyond computing and data power, we also had great girl power rather than manpower working on this report. Nearly everyone that worked on this report was female. And we worked in close partnership with our colleagues in marketing and external communications, compliance, legal, and then within my team, the investment stewardship team, to make sure that we were saying things, as I said, in a brief and clear way, but also in a way that would stand up to any potential accusations of greenwashing.
Wow. As you were just talking about that, I recall a conference session at an industry conference where they did talk about jargon as one of the things that kind of disenfranchise a lot of people when they're talking about sustainability, because it's like, what are you talking about? And now we have greenwashing as well to contend with. Now, in the report, you've mentioned 3 of your key achievements, shall we say, in 2024 under the banner of integration, active ownership, and last but not least, and we want to talk about this later, climate change. So it would be good to give our listeners an understanding of each of those kind of milestones. So let's go with active ownership first. Talk us through what you've done in this area, and does this set the expectations on what you'll be doing in the future?
Sure. Well, active ownership is one of the key levers or tools we use in our investment stewardship program to advocate for change. TCorp is one of the largest asset owners in Australia. We have the benefit of having really good access to the boards of leading companies across the Australian market. And so we vote all our shares ourselves. We don't delegate our voting rights to any other party. And for our portfolio holdings that we believe face the greatest ESG risks, we really want to understand those and hold the boards and management accountable for managing those risks. So we engage with about 30 to 40 of our largest holdings every year on material ESG risks, including climate change, good governance, health and safety, and cybersecurity. And we see a lot of progress in that. One of our key achievements over the last year, which is highlighted in the report, is expanding our active ownership program from just looking at shareholder value within a listed equities context and actually recognizing that we have far more influence and impact in our real assets portfolios. So in the direct properties that we own, in the infrastructure assets we own, where we typically have a board seat, sometimes multiple board seats. So really using that direct influence on the board to advocate for good governance, a credible low carbon transition, and really strong sustainable operating practices.
That's good to know. We recently wrote a special feature on real assets. So the private markets is continually being such a big part of whether it's superannuation money or it's government funds. Now, you did mention in the report, though, that one of your case studies is on a listed asset, being Qantas. Can you just quickly walk us through how you've executed this, your active ownership approach through that?
Yeah, sure. So we've been a shareholder in Qantas for many, many years, probably since it listed on the stock exchange. And it's been a priority company on our focus list for many years as well. So our engagement started pre-COVID on good governance, safety, customer experience. Then through the governance challenges that Qantas has had, we've engaged regularly with the chairman, the chair of the remuneration committee, the full board, the previous CEO and the current CEO. And we really want to gain better confidence that the board is holding management accountable for its strategic decisions and execution. We did have a concern that there was not enough constructive challenge of the prior CEO, which allowed certain decisions and positioning to occur in the market that really put off key stakeholders, including the regulator and customers. And so with Vanessa Hudson taking the reins as CEO, we have had some really good and challenging conversations with both her and the new chair about how she will manage stakeholder relations differently and how Qantas as a business will keep a balance between shareholder returns, employee satisfaction, customer needs, and managing its pretty damaged reputation with the regulator.
Yes, absolutely. And I think you mentioned in the report that you've, in fact, under the previous CEO, you've rejected a couple of the board recommendations. Is that correct?
We did vote against the remuneration report several times, and we did vote against the previous chairman because we really felt that that board was not sufficiently strong to hold management accountable and to really lead a real change program across the business. We are quite happy with the composition of the new board, but obviously there are always new issues that management teams have to deal with, and we want to make sure that there's a really cohesive relationship between the management team and the board, such that management gets the support they need to take a bold strategy, but you've got the right risk controls in place and people asking the questions of what could go wrong here and have we considered this possible unintended consequence. So we're comfortable with the current board, but there's always new issues to be addressed, and we'll, continue to monitor it.
Now, moving away from active ownership, but now about integration, about people. I know that you're very passionate about not just, let's say, a select number of people within your team championing ESG, that in fact you have 20 ESG champions within the business. What does that mean exactly?
So within the investment stewardship team, we're 5 people. 5 people can't be responsible for ESG integration, active ownership, collaboration, exclusions, and reporting across a nearly $120 billion portfolio. We are really subject matter experts And we work closely with a range of teams across the business to implement our strategy and to try to build investment portfolios that are resilient and that deliver long-term sustainable returns in light of ESG megatrends like climate change and good governance. So within our ESG Champions program, we actually have 2 ESG champions within each of our investment teams, so outside of my team. And their job is to be upskilled in understanding what does ESG mean for their part of the investment process, and then to prosecute that within their business and to be the voice of ESG within the decisions that are delegated to their part of the business. So as an example, we have 2 ESG champions in the property team and 2 in the infrastructure team. As they're looking at new investment opportunities, from the very beginning, they're asking, what are the most significant ESG risks and opportunities that this investment opportunity is bringing us? And can we get sufficient confidence that the risks are appropriately managed or the opportunity is genuine before we take this investment idea any further? And then throughout that investment process, through due diligence and valuation, they will work closely with someone in my team to really understand all the detail around ESG risks and opportunities facing that potential investment and incorporating it into decision-making.
From a practical point of view, does that mean you have regular meetings, like a monthly meeting, or is there like an offsite training program? How does it work?
So until recently, we had quarterly meetings, but we have interactions with the individual champions really on an ongoing basis. But we did make the decision to graduate the first class of ESG champions because they had done all of the upskilling that we wanted, and they were very well positioned to advocate and promote ESG within their teams. So we then asked them, well, what do you want to see from this program going forward? And they really wanted more of a sounding board where they could bat ideas around and test their thinking with their peers across other parts of the investments team. So now our meetings are a little bit more ad hoc. We have a dedicated climate working group, which is a bit more focused than the ESG champions. It focuses just on climate change. And that's working pretty well. But as I said, we're evolving as we learn and as the business matures. One decision that was recently made is that everyone in the investments team will have to do mandatory basic sustainable investment training, which will be in line with the PRI Academy Essentials program. So that will mean rather than just having 20 champions, that everyone in investments has a common playing field from which to understand sustainable investment and what ESG means in our portfolios.
Alexis, be very careful. You're raising the benchmarks for other fund managers. They're going to go, no, you have to upskill everyone. Now, let's talk climate change. We talk about climate change a lot here at FS Sustainability. We're very passionate about it, making sure that education is out there and what's happening here. Now, what's interesting with TCorp's portfolio is that you do have a very high 49% regional exposure in the US, which arguably has reversed a lot of the favorable climate policy, and they no longer support the net zero targets under the Trump administration. Do you see this regional exposure being different next year or a few years from now?
So I can't make concrete statements about what our portfolio allocations will look like in the future. But what I can say is that the US is a very deep and rich investment market with lots of great investment opportunities. It's dynamic, and I imagine that we will have substantial exposure to the US for the foreseeable future. But you're right to highlight that the US's withdrawal from the Paris Agreement is a setback for a global net zero journey. But it doesn't change the fact that many US companies are still pursuing a low carbon business model and are looking at ways to have more control over their energy needs in the light of volatility in the oil price, geopolitical risk, supply chain risk. So I think you will still see the US market decarbonize and transform to better address climate risk. But it won't be because there's regulatory pressure to do it. It will be because it's just good business sense. It makes economic sense.
I would say yes, but the skeptic in me think there's been a lot of strategies put on pause when all these policy changes were made. But it does feel like the pressure is going to come from the industry, not just from the government. Let's get technical for a moment. You've noted your improvements on your aggregate portfolio financed emissions intensity. It's a bit of a mouthful. Portfolio financed emissions intensity. Tell us about that and what is interesting about your findings.
So, as I said earlier, it took a lot of work to pull together our financed emissions data across our total portfolio. So, maybe for starters, what exactly are we measuring and how is that a little bit different from what your listeners might be familiar with? We're looking at the absolute scope 1 and 2 emissions of every company or asset in our portfolio, and we're aggregating that, and we're dividing it by the total economic value of those companies. So we're looking at debt and equity as financing those emissions. And then in the denominator of our calculation, we're looking at our total portfolio. So many other asset owners or investment managers might set a net zero target for their equities portfolio or their infrastructure portfolio, or maybe a couple parts of the portfolio, but not the full portfolio. Because of TCorp's deep commitment to our total portfolio approach to investing, we had to develop a net zero program that was reflective of this total portfolio approach. And so the decision to put our total capital in the denominator is quite different from what other funds have done. And the reason for that was really driven by a commitment to integrity, that we didn't want to be communicating that we were decarbonizing faster than we were, which is what can happen if you only look at part of the portfolio. Because you might, for example, decarbonize an infrastructure portfolio by 20%, but if that's a tiny part of your total portfolio assets, it's not really that meaningful, and in fact, it can even be misleading. So we wanted to be clear that we would like, in time, to capture the whole portfolio. There are certain pockets that are really challenging, like hedge funds and derivatives, but our bias was to include anything that we could in the numerator and to include the total portfolio funds under management in the denominator. And what does that mean for us now? It means we understand the carbon intensity of each part of the portfolio. And so when our portfolio managers are building diversified portfolios, they're looking to manage or to maximize return for a given unit of risk, and to build portfolios that are consistent with our net zero ambition. So they know now if I increase my allocation to Australian equities, my financed emissions will go up. If I increase my allocation to short duration fixed income, my financed emissions will come down because the relative intensities between those parts of the portfolio are clear to them and are embedded in their portfolio construction tools. So it was a lot of really detailed data and analytical work to pull together that model, but we think it's actually really empowering, particularly for our portfolio managers, but also for our clients. When we report on performance, we can show this is how we're performing against your investment objective. This is how we're controlling for traditional investment risk factors like volatility. And this is how we're tracking on our financed emissions journey with you. And that's really powerful.
I like it because it's like cheating if you only show the good numbers, right? I mean, you can game it if you can exclude certain assets. And if I recall correctly, even in your report, you didn't even say, oh, that's all us, the intensity has gone down. It's because of this, which again reflects what you've said earlier. Anything else you'd like to share with our listeners regarding this report?
If you look back at that ESG review that I mentioned at the beginning, Prue Bennett's number one recommendation, she said, the indicator of a best-in-class sustainable investment program is a commitment to continuous improvement. And we really have that at TCorp, and we have that in our investment stewardship program. We are always learning, new risks are emerging, and we need to be agile and able to pivot to address those. So as an example, we recently reviewed the carbon intensity of our global equities portfolio. And with the rise of the Mag 7, actually technology companies are now some of our highest emitting companies in the portfolio, which is something that we wouldn't have anticipated several years ago. So when you want to engage a Microsoft around their net zero journey, it's a very different conversation than when you're engaging an ExxonMobil or a Shell. So we need to listen well, watch the data, be prepared to pivot, but most importantly, to be prepared to learn and to be humble in the way we communicate.
Well said. Alexis, thank you for joining us.
Thank you for having me.
This is The Greener Way. I'm your host, Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.